Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Monday, July 27, 2026. We're Elena and Marcus. This episode is brought to you by Bank Atlas, where the risk of every bank is quantified via proprietary grades and analysis. Learn more at bankatlas.com.
You know, if you had told me oil would crash 10% in a single session, I'd have assumed tech stocks would just fly on the inflation relief, right?
Right, you would think so.
But instead, the exact opposite happened today, and it is exposing a massive crack in the artificial intelligence narrative.
Indeed, today's proprietary updates are presenting a deeply complex picture. There are three critical themes in today's data deck that we really need to unpack.
Got it. So first, we're tracking this massive geopolitically driven collapse in crude oil, which is just aggressively reshaping near-term inflation expectations.
Correct. And second, beneath what looks like a totally flat index surface, we are seeing a violent equity rotation.
Right. The market is aggressively selling semiconductors, mostly due to mounting AI, capital expenditure fatigue, and fresh Chinese competition.
And third, our daily desk data is flagging a highly unusual divergence in credit markets. Tech giants are suddenly seeing their borrowing costs rise.
While the broader high-yield market just remains remarkably calm, it's a lot to cover.
It is. So we need to start at the 30,000-foot macro level. We're watching this sudden collapse in energy prices transmit directly into the bond market.
And that is actively altering the Federal Reserve's immediate calculus, right?
Exactly. Let's look at the Treasury movements from today's run. The 10-year Treasury yield rallied modestly. It settled at 4.651%, which is down 2.8 basis points.
But the really aggressive repricing happened in the inflation-linked bonds, didn't it?
It did. The 2-year TPS break-gain plummeted 8.7 basis points to 2.147%, and the 5-year actually hit a 52-week low.
Wait, before we get into the Federal Reserve pricing, can you just remind me how the math on TPS break-evens actually reflects that inflation drop in real time? Let's establish that underlying mechanism first.
Correct. It is a crucial mechanism. So TPS stands for Treasury Inflation Protected Securities.
Right.
The break-even rate is simply the mathematical difference in yield between a standard fixed-rate Treasury bond and a TPS bond of the exact same maturity.
Okay, so because the principal value of a TPS bond adjusts with the consumer price index, that yield spread essentially acts as a real-time scoreboard.
Exactly. It's the market scoreboard for future inflation expectations. Traders are constantly buying and selling that spread based on where they think inflation is heading.
Over that specific time horizon.
Right. So when the 2-year break-even plummets 8.7 basis points in a single session, the collective market is loudly stating it expects significantly less inflation over the next 24 months.
Because the sudden 10% drop in crude oil mechanically pulls down those forward-looking expectations.
Correct. Since energy costs bleed directly into, transportation, manufacturing, and basic consumer goods.
I mean, it really feels like the Federal Reserve was bracing to steer this massive cargo ship through a rising tide of inflation, and suddenly this oil crash just drained all the water out from under them.
That is a perfect way to look at it.
So does being stranded on this sudden disinflationary sandbar actually change Wednesday's Federal Open Market Committee decision? Because our data deck is showing some slight contradictions.
It is. So the market is implying a 38% probability of a hike on Wednesday, with the implied overnight rate sitting at 3.725%.
Yet the broad institutional consensus expects a hold.
Right. The Fed generally tries to look through volatile food and energy prices, to focus on core inflation.
But a near 10% drop in crude oil in a single session is just too large an economic input to ignore.
Exactly. That 38% probability of a hike reflects a residual fear of underlying sticky inflation in the services and housing sectors.
Plus, there's the mounting political pressure to act.
Correct. Yet the violent drop in break-evens today strongly supports the consensus view of a hold for Wednesday.
Because the bond market is acknowledging that the disinflationary impulse from oil gives the Fed the cover it needs.
Right, to maintain the current rate. But notice that the forward path still prices a hawkish terminal rate near 4.2% by April 2027.
So the market is saying the Fed can pause now due to oil, but they still have to guard against structural inflation later in the decade. Moving to today's data, we need to examine how these macro interest rate moves are translating to equities.
Because this is where the divergence gets glaring.
Right. Normally, falling inflation expectations and lower yields act as this massive tailwind for tech stocks. But today, the S&P 500 closed essentially flat at 7,413.0 weights.
And beneath that, We witnessed a brutal semiconductor sell-off that entirely ignored the rate relief.
So what drove the flat index level?
Well, the S&P 500's flat performance today was entirely dictated by the options market structure. Our daily desk data shows a gamma-neutral profile effectively clamped the broader market.
Which resulted in a textbook round-trip fade.
Exactly. The market gapped up at the open to 7,480, faded all the way down to 7,393, and then just ground its way right back to flat.
For someone who isn't staring at options flow all day, explain how that gamma-neutral environment acts as a clamp. It's essentially like a giant shock absorber.
That is a perfect way to visualize it. Options market makers, the dealers who facilitate these trades, have to constantly buy and sell the underlying stocks to keep their own books balanced or hedged.
Okay.
So in a gamma-neutral environment, their hedging algorithms are programmed to sell when the market rallies and buy when the market dips.
Right, so there's no strong directional momentum.
Correct. Price action tends to mean revert back to the center rather than cascade in one direction.
Yet beneath that flat, clamped surface, breadth was actually quite positive. I mean, 328 of the 503 S&P 500 names advanced today.
We tracked a massive rotation into consumer staples, consumer discretionary, and software.
But the pain was intensely concentrated in tech hardware and semiconductors. I mean, NVIDIA dropped 5.0%.
That was amidst talks of a massive $250 billion financial backstop for OpenAI in Ohio.
Right, and that NVIDIA news represents a critical shift in how the market perceives risk, doesn't it?
Indeed. For the past 2 years, any headline involving massive capital expenditure for AI infrastructure was bought aggressively. Now, a $250 billion backstop is raising serious alarms.
Because the debt markets are going to demand heavy concessions to fund projects of that sheer scale.
We're talking about strict covenants, higher yields, or pledging core assets.
And when the debt markets demand more of the pie, it just compresses the equity multiples.
Exactly. It highlights the growing balance sheet risk associated with AI infrastructure. And the pressure on semiconductors today wasn't just domestic.
Right. ASML plummeted 8.5%.
Yes, on reports that a Chinese state-backed firm is now mass-producing homegrown, deep, ultraviolet or DUV chip-making tools.
And you have to contrast that drop in ASML with what happened in Shanghai today. I mean, CXMT, the Chinese memory chip maker, surged 466% on its market debut,
reaching a $488 billion valuation.
Which is staggering. You have to think about the mechanics of the global memory market, which is highly commoditized. If you add massive Chinese domestic supply while simultaneously removing Chinese domestic demand for Western chips, you crush the pricing power for everyone else.
Understood. That dynamic is a structural threat to the global semiconductor cycle. We also saw Tesla plunge 14.5% post-earnings today.
Right. They were heavily punished for failing to clear a high bar as a deeply well-owned name.
Meanwhile, Apple outperformed the NASDAQ 100, acting almost as a defensive AI-leveraged safe haven with its massive cash pile.
Let's look at the underlying investor flows here, because they tell the story of this divergence perfectly. Retail margin balances in Japan are near all-time highs right now, with mounting mark-to-market losses.
Conversely, retail investors in Korea are actively bottom-fishing the Kospi, aggressively buying the dips in major memory names like Samsung and SK Hynix.
But the institutional consensus is telling a different story entirely, right?
It is. The institutional consensus shows a very clear, coordinated pivot away from memory and semiconductors.
It feels like building this AI infrastructure is starting to look less like building toll roads with guaranteed recurring revenue and much more like building a massive Olympic stadium.
That's a great comparison. The upfront costs are staggering, but the long-term utility and actual recurring payoff are suddenly being sharply questioned.
So are institutional investors finally demanding to see the actual return on invested capital rather than just blindly funding the build-out?
They are, and that is the exact pivot point of the current equity market. Investors are heavily scrutinizing the income statements now.
Right. They want to see exactly how a $250 billion data center translates into quarterly software and service revenues.
Exactly. When hyperscalers signal massive increases in capital expenditures while reporting negative free cash flow in those specific AI divisions, institutional patience just evaporates entirely.
On that point, we really must drill down into the epicenter of today's market shock.
You mean the raw commodities that violently repriced due to geopolitical headlines?
Yes, which ultimately catalyzed this entire equity rotation. WTI crude crashed 9.46% to $81.91, and Brent dropped 10.85% to $87.99. Natural gas also fell 5.0%.
This violent repricing was driven directly by weekend headlines indicating a pause in U.S.-Iran military strikes and potential diplomatic negotiations.
So the market just rapidly unwound the geopolitical risk premium that had been supporting the entire energy complex.
Right. Let's unpack how that unwinding actually executes. Because an 11% drop in Brent crude isn't just people changing their minds. This is algorithmic, right? Traders had aggressively bought oil fishers to hedge against the supply disruption in the Strait of Hormuz.
Correct. When those weekend headlines hit the terminals, the probability of a supply shock dropped to near zero.
So all those speculative long positions hit their stop losses simultaneously when the futures market opened on Sunday night.
Which creates a massive wave of forced selling that just feeds on itself.
Which brings us to a glaring contradiction in today's data deck. If oil is collapsing by nearly 11% and mechanically pulling inflation expectations down with it across the bond market, why did gold firm up by 0.58% to $4,076 per ounce?
Right, because gold is traditionally viewed as the ultimate inflation hedge.
Exactly. Furthermore, our proprietary updates show physical gold imports to China just reached a 2-year high today.
It is a vital observation. Gold is officially divorcing from its traditional role as a pure inflation hedge.
Right.
Right now, gold is trading on residual geopolitical fear, consistent central bank demand, and broad dollar diversification.
So sovereign actors and institutions are accumulating hard assets regardless of the immediate inflation data.
Indeed. The physical imports into China suggest these actors are hedging against systemic instability and currency debasement rather than just reacting to month-over-month consumer price index fluctuations.
And we're seeing global ripple effects from this instability, particularly in emerging markets.
Yes, the Indonesian rupiah and local equities dropped sharply today following the unexpected resignation of Bank Indonesia Governor Perry Warjio.
It serves as a stark reminder that emerging market stability remains highly fragile in this shifting macro environment.
Understood. So let's pull all these threads together to define the exact economic regime we are currently navigating.
Right, we have falling interest rates, violently rotating equities, crashing oil, and highly resilient gold.
Our updates show the U.S. economy is severely bifurcated. Broad financial conditions have been tightening due to the recent rise in the 10-year yield.
Yet the real-time current activity indicator just accelerated sharply, jumping from positive 2.9% in June to positive 4.2% in July.
That surface-level economic resilience is masking a profound shift in the credit markets. Today's data deck shows that credit spreads for hyperscalers, the massive tech companies building this AI infrastructure, have widened roughly 20 basis points to year-to-date highs.
And this is directly due to the massive capital expenditure concerns we discussed earlier regarding NVIDIA and OpenAI. And just to clarify, a credit spread is essentially the premium a company has to pay to borrow money compared to a risk-free treasury bond. So the bond market is demanding higher yields to lend to the most historically cash-rich companies on Earth.
Correct. But here's where the divergence becomes historic. While hyperscaler spreads widen, broader corporate credit remains near generational tights.
Right. Specifically, BB spreads are remaining incredibly stable.
Exactly. BB being the higher tier of junk bonds or speculative-grade corporate debt.
It is as if the safest, most cash-rich mega mansions in the neighborhood are suddenly getting charged higher mortgage rates by the banks, while the riskier, speculative fixer-uppers down the street are getting prime rates without a second thought.
That analogy captures the pricing dynamic perfectly. The bond market is ruthlessly efficient at pricing forward risk. So when hyperscaler credit spreads widen, while BB credit stays tight, the bond market is explicitly stating that the concentrated risk of AI overinvestment is currently a greater threat to balance sheets than the general macroeconomic risk facing average lower-tier corporations.
So what does that actually mean for the equity investor trying to pick stocks in this environment?
It signals a definitive transition from a liquidity-driven market to a fundamental-driven market. And we can see this transition playing out in the earnings reaction function, which has entirely inverted.
Right. Historically, positive earnings per share beats generated a positive 98 basis points of outperformance against the broader market on the day of the release.
But in 2026, our data shows those exact same earnings beats are now generating a slight underperformance of -3 basis points.
So the market is using strong earnings as profit-taking liquidity events.
Indeed. We are operating in a priced-for-perfection environment. When a highly valued company reports good news, institutions aren't using it as a reason to buy more.
They're using the surge in retail buying volume as an opportunity to exit crowded trades.
Correct. The fundamental bar for outperformance has simply been raised too high for the current macroeconomic reality.
This brings us to a final thought to consider as we close out today's deep dive. We are entering the teeth of the midterm election seasonality.
Right, and historical data since 1974 shows the S&P 500 typically generates a median return of exactly 0% from August through Election Day.
Given today's hyper-bifurcated market, with mega-cap tech stalling, massive AI capex questions, and capital rotating violently beneath the surface, it really begs the question, are we entering a grueling range-bound chop where index-level returns stall entirely?
It is the most probable outcome. When the indices are pinned by gamma-neutral option structures and macroeconomic forces like falling oil and rising tech spending pull the market in opposite directions, passive index investing historically struggles.
So investors will likely be forced to rely solely on alpha generation and precise stock picking beneath the surface. To quickly recap today's core takeaways, the geopolitically driven crash in oil is sending a massive disinflationary shock through the bond market, pulling down TPS break-evens.
However, that rate relief is being entirely ignored by the semiconductor sector, which is facing a harsh AI capital expenditure reality check and rising Chinese competition from firms like CXMT.
And finally, this is all culminating in a historic credit divergence, where hyperscaler borrowing costs are rising while broader high-yield credit remains perfectly calm.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color.